Have you been looking like what are the standout signals for inflation that you're actually seeing, and is there anything that's been is slightly misleading? And I say that because I think sometimes Bitcoiners can cheerlead some of these figures as an indicator that people should be invested in Bitcoin, but perhaps they're misleading.
Exactly. Yeah, and I agree that some of them are misleading, and it's one of those things where because it's a sensitive topic, inflation, there's kind of misleading aspects on both sides, and that's it. So, the misleading part about some of those year-over-year numbers that Joe was correct about is that you're comparing that 1 year where commodities fell into a hole, right? Because China just like stopped buying energy, stopped buying copper. They're the biggest buyers. They were totally shut down, and then you kind of exploded out of that big kind of down part. And so the year-over-year numbers are ridiculous. But for example, if you back up and you look at commodities over the past 10 to 15 years, most of them actually are not at all-time highs. So lumber is, that's been like it looks like a Bitcoin chart. And then you have gold touched new all-time highs in 2020. It's been in a correction, but it still touched it. Beef is at all-time highs. But for example, the overall, if you take an aggregate of most commodities, it's actually been in like a 10 to 15 year bear market. And it's because we had a period of, in the 2000s, you had a period of, China had a fast growth rate. There was a lot of commodity demand. We brought a lot of new commodity supplies online. And then when China slowed down and the whole world kind of adapted to this, we've been in this period of commodity oversupply. And so I think a lot of those year-over-year numbers, basically a lot of commodities are just getting back up to where they were before. Like oil is just back up to where it was before the pandemic. There's some like copper that are elevated but still not at all-time highs. And then there are some that are at all-time highs like lumber. But then the funny thing is if you look at timber, right, which is before it becomes lumber, it's timber, that's actually not that expensive at all. It's really about the bottlenecks of turning timber into lumber, right? So the basically the refining that has to go into cutting that up and getting it treated. And so a lot of that is about supply chain issues. Same thing we're having in the semiconductor industry where, there's just there's not enough foundries to make the semiconductors. And so on one hand, kind of focusing on those year-over-year numbers can be misleading and can, for readers that know what those base effects are, that could even turn them off they think, okay, this people in this industry don't know what they're talking about. On the other hand, people that are saying there's no inflation, especially over these several years, are also misleading because CPI is a really crappy statistic for the most part. And I actually have a chart coming out later today that just shows, housing has gone up faster than a CPI, food has gone up faster than CPI, healthcare has gone up faster than CPI, tuition's gone up faster than CPI. The cover price of the New Yorker magazine has gone up faster than CPI, a lot faster. And so basically we've had a couple deflationary areas like consumer electronics or things that you can outsource to China. Those have been, globalization, technology. They've really pushed down the cost for things. Same thing, your cell phone can now do what, 10 of your electronics could do, a decade ago. So that's been the deflationary area. But then pretty much anything you can't outsource or that isn't automated has gone up faster than CPI. And for most household budgets, that's still where they spend most of their money. Housing, education for their kids or themselves, healthcare costs, either through themselves or through their employer, which eats into their compensation total. Those are the areas where we spend most of our money. And so it's one of those things where we actually have had pretty significant inflation over the past, 10, 20 years. But that year-over-year number is still somewhat misleading for how fast it's been. Some of the things I'm looking at are the producer price index, which is kind of a precursor to inflation. That's been spiking. Just the overall kind of, you can look at the bottlenecks in the industry, like we talked about the semiconductors, we talked about lumber, we're seeing that in shipping over the past few months, where just, there's only so many containers and container ships. And so we have had various supply chain issues. And so that's how I'm monitoring it, where it's often the case that the truth is in the middle. And that's what I'm finding here with inflation as well, that we are getting an inflationary impulse from this fiscal spending, but it's not like inflation is, is absolutely massive in that 12-month period.
Yeah, because one of the things I struggle with inflation is I think it's one of those things that's quite relative. It may be a good measure of the general cost of living, the changes in the cost of living month on month for people, but for example, someone like my children doesn't really affect them. But what does affect them is if house prices accelerate to such a rate where where maybe they're in their 20s and they will want to buy a house, it's really pushed it out of reach for them. So is the CPI a fair rate of calculating inflation? Should we have multiple calculations?
I think there should be multiple kind of measures of inflation, and in some sense there are. I mean, that's why there's things like producer price indexes are useful. You can also just look at, what is the raw, commodity index doing? So what are commodity prices doing? That's one of the big factors of inflation. Generally, you don't have strong inflationary periods without commodity prices also going up a lot. But like I said, over the past decade, the problem is that, the big areas of spending that most people spend their money on have gone up faster than wages and have gone up faster than the official CPI. And so that includes housing, that includes food, that includes healthcare, tuition, childcare, things that you can't outsource or that are not deflated away by technology and smartphones and things like that. And so, whereas, on the other hand, your TV got cheaper, your computer got cheaper, but those are generally pretty small percentages of a household budget. And so some of those other, things are really important. Another factor that's weird about housing is that, obviously CPI does not really take into account most asset prices. So it doesn't take into account asset price inflation in the stock market or private businesses. It only partially factors in real estate, but it does it in a weird way. And so you actually have a thing where, houses have gone up faster than inflation in most markets. So they've outpaced inflation. But then, for example, because we've been in this kind of multi-decade trend of lower interest rates, including mortgage rates, the actual monthly payment to afford a house hasn't really gone up that much, even though the cost of the house has. And so that can push down kind of the quirky, wonky, the cost of owning a shelter. However, it's unfortunate that doesn't change the fact that people still have to take on more debt relative to their income in order to afford that house. And so basically, it just means that of the monthly kind of plan that they're doing, more of that at least goes to the house than goes to interest to the bank. But it's basically those policies are still propping up housing prices. And so an ideal case would be to have for especially for new people entering the market, for housing prices to be cheaper than they are, especially on a ratio of housing price to median annual wages.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
Is there any risk whereby we come out the long-term debt cycle, and I don't know what point that would be, but interest rates will then start to go up and people might be trapped with payments they can't afford on houses they've taken on with these low interest rates? Is that a serious risk? Is that a serious concern for central banks when setting interest rates?
Well, that was a big factor in what caused the subprime mortgage crisis, back in 2007, which was that these people, they bought it. There was predatory marketing, really dumb, things by banks, and then people bought into houses they couldn't afford, and so a lot of them, the way they did it was they had a really low variable rate, and so after 5 years, that had a contracted thing where it could bump up to a market rate, and suddenly they couldn't afford that house anymore, which they really couldn't afford it from the beginning, but now they literally couldn't afford the payments. And so that triggered this cascade of defaults that happened. And now, so that's not a problem for people that have, say, 30-year fixed-rate mortgages or even 15-year fixed-rate mortgages. I know different countries all have different kind of practices for what is normal for kind of a housing financing scheme. And so it is a factor for variable rate mortgages. And so generally, after a long-term debt cycle, usually interest rates normalize. But there's always a big question of what is a normal interest rate, and obviously it changes based on what society is doing, what demographics are like, whether there's a period of kind of technology boom happening. Technology doesn't really happen linearly, right? We have these big discoveries like the using oil or the internal combustion engine or electricity or the internet and smartphones, right? So you have these kind of bursts of growth, and that can kind of temporarily suppress costs for a number of years. But over time, interest rates, should eventually normalize, but I wouldn't expect that anytime very soon. And it's one of those things where, if you had a theoretical environment, like say the free banking era in the United States, where you didn't have a centralized yield setter, then you have different institutions setting different rates, which is actually kind of what we see in the the crypto lending markets, where you have different entities setting rates. Some of them are more conservative than others, and so you basically are willing to accept a lower rate. Other ones are push that more, and so you kind of saw that in banking systems in some periods of time. Whereas lately we've had a more centralized rate setting mechanism, which doesn't necessarily correlate with the actual what the cost of capital otherwise would be.
Right. Okay. Last question on inflation, because you mentioned there the producer rate at around 7% would hint to a maybe 3 or even 4% CPI inflation rate. What numbers are concerning? I know it's for different people. What numbers would be starting to say? I don't know if it alarms you, Lyn, but makes you really kind of think, okay, there's a problem here. What numbers do you think concern the government, or do they not? I mean, is this what we've talked about previously, where they want higher rates so they can clear their debts? What numbers perhaps should people listening be concerned about?
So for me, it really depends on what assets you are focusing on. And so, from what I'm looking at, the math shows that about 3% CPI this spring is kind of just the entry fee, right? So that's like from base effects alone and kind of moderate inflation, we should touch around 3%. Now, if you were to get 5%, that means there's more than people are expecting. And so there's numbers like that to watch out for. Now, from the government perspective, they obviously different central banks have different policies. Right now, for example, they generally are looking for more inflation, and it's their way of measuring it. And so, for example, the Federal Reserve uses core PCE, which kind of like the CPI basket is not it's not a fantastic gauge of inflation. But from their perspective, they want that to run hot. And so the Fed's long-term average annual inflation target is 2% a year. The way they measure it, it generally undershot that for most of the past decade. And so now they want to overshoot it, a certain period of time, so that they can have it so that it, in hindsight, it averaged 2%. And that's the way they measure it. And so the challenge for them is, it looks really bad if say PCE is like 3%. And they're saying we're still going to hold interest rates at 0, right? Because that means if you're holding money in the bank, then based on the way they're measuring inflation, you're losing 3% a year. And so there's concerns of, well, if inflation gets out of control, is the Fed going to let that? How hot are they going to let it run? And so they have a delicate balancing act of trying to you're going to push the narrative that it's transitory. And they're also going to push the narrative that they, quote unquote, have tools in case, inflation gets out of control. Now, the problem is that their tools are also things that would crash a lot of these bubbles that we see. And that's kind of goes back to how, as we look later this year, we have to be we have to be mindful about some of these central banks maybe trying to taper some of their activities because they could start causing some fun activities in the market, you could say, where the bulls and bears kind of wake up a little bit and things don't operate so smoothly. And so that's how I'm kind of watching that play out. And another factor is that, when we look at inflation, is the idea of transient inflation, but that implies that prices go up and then come back down, right? So that's what you think of when you hear transient inflation. But what history usually shows is that inflation often comes in bursts. So the rate of change of inflation is transient. But then it inflates, but then it stays up to that level, and it's like a new plateau. So, for example, if you look in the 40s, you had 3 inflation spikes, and they were transient in terms of what the annual inflation rate was. So it didn't keep accelerating, but it never came back down. It just went up to that new level and stayed there. And of course, you can have individual things come back down, like for example, I think lumber will not be at this level permanently. As an example, there will be individual things that come back down. But for example, we're starting to see companies like Coca-Cola or Procter & Gamble raise prices. And I don't think you're ever going to see those, they're not going to be like in 2022, like, oh, the pandemic's over, we're going to go ahead and reduce our prices. No, we've permanently increased the amount of money in the system. And so a lot of these prices will be sticky, even if they don't go up at the same rate every year.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. you will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.